Hey everyone, and welcome to this explainer. Look, let's just jump right in, because the 2026 fintech landscape, it has completely shifted beneath our feet. If you're still running that old Silicon Valley playbook, move fast and break things, you are playing a game that honestly ended years ago. Today, we're looking at a financial sector where these massive hiring booms aren't about building a prettier app interface to drive consumer demand. No, they're driven by intense regulatory mandates, and this do-or-die need to modernize infrastructure. We are literally in a world where digital payments are nearly 100% of transaction volume. The pressure to ditch those ancient legacy COBOL ledgers for real-time settlement is absolutely immense. So today we're going to unpack exactly how you actually manage product compliance velocity in this incredibly high-stakes environment.
To really set the stage here, check out this quote. Not user obsession, but failure containment is the real KPI. This hits the nail right on the head. Our sources pointed out that at a recent hiring committee for a Tier 1 digital bank, 9 out of 14 approved product manager rules were for core banking replatforming, not app features. And the driver wasn't users complaining about the UI, it was a hard 12-month compliance deadline. Think about it. Growth metrics and user obsession mean absolutely nothing if your product triggers systemic risk or, say, sets off a false overdraft cascade just because of some latency issue in your reconciliation.
And that brings us to this stark divide in the talent pool today. On one side, you've got traditional tech product managers. They're optimizing for engagement, daily active users, session time, the whole shebang. But on the other side, modern fintech teams. They are optimizing for survivability, auditability, and failure containment. Actually, there's this wild anecdote from our sources about a recent interview for a crypto wallet role. The hiring manager straight up rejected a candidate who had mind-blowing growth metrics from Meta. Why? Simply because the candidate brushed off compliance as an afterthought during the roadmap exercise. In fintech, treating compliance as a tomorrow problem is an immediate deal breaker. No way around it. So, now that we know we're playing for keeps, here's the strategic playbook we're going to cover. We'll start with the constrained innovation game, then move into navigating regulatory no zones. After that, we'll hit the new survival KPIs, dive into design-led compliance, and finish up with architecting real-time velocity. All right, let's kick things off with part 1, the constrained innovation game. Like we just talked about with those recent hiring booms, the whole mandate has flipped. It's all about infrastructure modernization and hedging against systemic risk, and that puts the modern fintech professional right in the middle as this essential translator. On one hand, you have legal and compliance teams demanding absolutely zero regulatory exposure. On the other hand, your engineering teams are telling you, hey, to build that audit trail, we need at least 6 months. Your job? You have to grow user value while minimizing the surface area for regulatory penalties. It's like a giant puzzle, and it's especially critical right now since institutions are executing these massive, incredibly risky migrations away from 40-year-old mainframe systems toward modular, cloud-native infrastructures. You're the one building the bridge.
Which leads us perfectly into part 2, navigating regulatory no zones.
We are stepping into a literal minefield of product development here. Honestly, moving fast and breaking things will just get your product killed by internal audit before it even launches. Take this cautionary tale from our sources. A product manager at a fast-scaling neobank shipped this gorgeous, beautifully designed one-click savings feature. Users loved it. It was a massive hit, boosting opt-ins by a staggering 37%. But, plot twist, just 2 weeks later, the entire thing got rolled back, completely pulled. So why in the world would a company kill a highly successful engagement-driving feature? The culprit was UDAAP. That stands for Unfair, Deceptive, or Abusive Acts or Practices. Internal audit flagged that incredibly seamless one-click feature as a potential UDAAP violation. Why? Because it was almost too frictionless, which meant it could potentially obscure important terms from the consumer. It just goes to show this harsh reality of the 2026 landscape. Consumer delight simply cannot and will not supersede compliance. The big takeaway here is that failing to consult compliance pre-launch is a fatal product error. That PM from the story didn't loop the compliance team into the design process early on, and it cost them the entire feature. In modern fintech, you don't really own the roadmap in the traditional sense, you steward it. You guide it through layers of intense regulatory control. Pitching a feature and saying, oh, we'll just add compliance later, that is for sure the fastest way to get a job offer withdrawn or a product completely blocked. Okay, moving on to part 3, the new survival KPIs. So if traditional SaaS funnels are out, how do we actually measure survival? Take a look at how global regulators like the FCA in the UK, the ECB in Europe, and the OCC in the US structure their dashboards. Spoiler alert, They do not care about your customer acquisition cost. They couldn't care less about your net retention revenue. What they want to see are operational KPIs. They demand hard reports on transaction monitoring effectiveness, the exact quality of your KYC or Know Your Customer funnels, and strict capital and liquidity metrics. If your internal dashboards aren't mirroring these jurisdictional reporting standards, you are basically flying blind in the eyes of the law.
And just look at the massive gap here. This highlights one of the absolutely most vital survival KPIs out there, the AML, or Anti-Money Laundering Alert to Conversion Rate. Did you know AML compliance is the single largest operational cost driver outside of acquisition spend? It's huge. A mature operation usually hits a conversion rate somewhere between 5 and 20%, meaning 5 to 20% of automated alerts actually turn into a suspicious activity report. But if your rate drops below 5%, you've got an over-alerting system on your hands. You're drowning your analysts in false positives and literally burning millions of dollars in wasted time. And no, you can't just slap a Band-Aid on it by raising the alert thresholds, because that immediately spikes your regulatory exposure. You really have to fine-tune your models to catch real threats efficiently.
All right, let's shift gears to the solution in Part 4, Design-Led Compliance.
Now that we've looked at the regulatory hurdles, here is your structural blueprint for design-led compliance. The secret here is integrating it from the very first line of code. You can't just bolt compliance onto the end of a build. You have to weave it natively into the user journey. Step 1, co-create with your risk teams early in the ideation phase. Get them in the room. Step 2 relies on an API-first modular architecture. By exposing banking capabilities through APIs, you can actually embed automated controls straight into the workflows. And Step 3? Implement tiered, stepped KYC verification. This is brilliant because it matches the level of friction to the actual risk of what the user is doing, instead of just hitting them with a massive conversion-killing questionnaire right at the front door. To put that into perspective, check out this quote from a highly successful product manager candidate. "We improved completion by 22%, but reduced false approvals by 60% through stepped KYC." That right there? That is exactly how a winning fintech professional talks in 2026. Notice they don't just brag about increasing onboarding completion by some huge number, because if that surge brings in a wave of fraudulent accounts, you've completely failed. Instead, they lead with risk-adjusted metrics. They prove they can optimize the user experience while simultaneously tightening up those audit and compliance controls.
Finally, let's wrap up with Part 5, Architecting Real-Time Velocity. So how do we actually move fast without sacrificing all these strict compliance rules? Let's start by looking at this number, 24 hours. Back in 2022, a 24 to 48-hour end-of-day batch processing cycle was the baseline for reconciliation. It was totally acceptable. But today, it completely fails the customer experience bar. When your users expect instant transfers, having a 24-hour back-office cadence is just a massive customer complaint generator. It just doesn't cut it anymore.
Now contrast that with this. Under 1 hour. This is the new gold standard for reconciliation cycle times for payments-heavy operations. We have officially shifted from batch to real-time. But getting your operational latency down to under an hour isn't just about making the app interface feel snappy to the user. To pull this off, it requires a massive, ground-up overhaul of exactly how data flows through your entire institution. Here are the heavy hitters, the specific technological drivers making this sub-hour velocity possible. First, we're seeing widespread adoption of the ISO 2022 messaging standard, which gives us much richer, structured data with every single transaction. We're also leveraging real-time payment rails like FedNow, RTP, and SEPA Instant. To actually manage all this speed, teams are building multi-source reconciliation engines that match data across sales channels, gateways, and ledgers, all at the exact same time. And this next one is absolutely crucial. They are deploying automated exception handling workflows. Because honestly, the happy path matching isn't what creates bottlenecks. It's the manual human review of flagged transactions that really slows everything down.
And I want you to notice the crossed-out smiley face here. 99.99% uptime, it is no longer just a vanity metric for user delight. In this era of banking as a service and embedded finance, back-end stability is strictly tied to compliance. Every single outage, every dropped API connection, it can instantly trigger a regulatory reporting event. Managing API contract drift, maintaining your settlement service level agreements, continuously scoring partner risk, these aren't just nice-to-haves, they are mandatory practices if you want to avoid intense regulatory scrutiny.
So I'll leave you with this somewhat provocative question to chew on. Are you still playing the engagement game, obsessing over clicks and session times? Or are you ready to master the constrained innovation of 2026? Because the winners in this new landscape, they won't be the ones building the flashiest UI. The winners will be those who can architect resilient, real-time systems that perfectly balance incredible user value with bulletproof compliance. Thanks so much for joining me for this explainer. I really hope this gives you a powerful new lens on the future of financial products.